Hi there, it's Bill with Smart Trades, and it's Friday, September 17th, around 11:30 a.m. Pacific time. Wanted to do a quick review here because I think the markets are in kind of a complex and somewhat confusing, at least to me, uh, pattern of higher highs and small corrective declines. At any rate, here's the S&P cash chart that I sent out earlier. Um, and you will note that earlier today there were quite severe bearish divergences on the advanced decline line against price. We had a spike up out of what I would interpret as a triangle on the S&P cash. And at that time, I labeled this as a possible fifth wave of three. That's still a possibility, and if it is the case, a likely retracement level would be down to approximately the 1090, perhaps 1100 area basis the S&P. Um, and again, that is a possible count, but it's come to my attention that I could be wrong. Happens all the time, trust me. At any rate, here's the first thing of note is the advanced decline line has actually kicked up. You can see that very bearish divergence on the opening bar, and from there advances have rallied quite a bit. Now there's still a bearish divergence relative to the previous highs, and that I think does set the stage for a potential top down the road. But the fact that we've popped through there on the advanced decline line, I think indicates the possibility, certainly, that I'm wrong and that the market's going to go higher before it goes lower. I would be wary, that said, that I could be right, that that indeed may have been a short-term peak. So the bottom line is here, I'm not sure, and I think that sometimes it's best to be clear when the market is a bit uncertain that that's the case. Here is the count on the spiders. And first off, the spiders did not make a new high, so there's no divergence to be had on that new high because it didn't exist. And that brings up a possibility of a somewhat different count that in some ways fits better. And that being that this entire pattern is actually a larger fourth wave correction, perhaps correcting this entire run up with a very large sideways pattern, and indeed a contracting triangle. In some ways, I think this fits better with the longer term picture, and I'll show you why. Here's the spiders on the daily, and on the spiders you have a somewhat different pattern down off the lows, and the idea here that if we have a fairly large correction down to, let's say, 1090, and then have to come all the way back up to the 116 level or so to fill that gap from back in mid-May. I think that's a less likely scenario in terms of timing. On the other hand, if we have a rather shallow sideways correction and a quick spike, I think that is kind of setting up as the more likely scenario. It'll be a bit of a bull trap. We'll be breaking out above the August peak, and that will probably suck in a lot of trend followers and so on, and then perhaps we'll fill that gap and create a peak. At any rate, all this, it's too early to tell. Let's watch it and see how it plays out, but I am beginning to like this scenario, and I'll show you a little more data that bolsters that, and that would be the Google, as they say. Google tends to be a leader for the stock market in general and the NASDAQ in particular. And you can see here clearly on the NASDAQ cash, we have what appears to be yet another triangle. And the implication of that is that there's higher prices to come, that we may have a reversal shortly, at least on the short term. But triangles tend to be continuation patterns. They tend to be broken out in the direction of the trend, which obviously on this short-term pattern is up. And here's Google again. It's pretty much straight up today and breaking out above the recent highs. You know, not extraordinarily strong, relatively speaking, to the NASDAQ or the S&P, but that short-term strength I think bodes for a continued rally, at least in the short term, as does the NASDAQ pattern. And the NASDAQ, as we've talked about before, does tend to lead the broader market. That said, I want to do a quick look here back in history. This is the pattern off of the 1987 low, and this pattern, to my way of thinking, I think to most people who look at it honestly from an Elliott wave perspective, and even just a regular pattern recognition perspective, the pattern off of that low looked highly corrective. Here's the Elliott count. This would be a triangle, a small fifth wave failure, and then an A, B, C, X, A, B, C. Overlapping, weak rallies, you name it, it just looks very corrective. Okay, that said, we all know how it turned out, but here's the picture. Here's that little corrective rally. Well, obviously it wasn't corrective after all. It was a series of 1-2, 1-2s to the upside, out of which we exploded and kept going for more than a decade, not including the rally from the 2002 low to the 2007 peak. So anyway, the reason I point this out is that even the most perfect, and I put that in quotes, Elliott wave or pattern recognition type patterns sometimes just don't work out the way they should. So let's be careful here. There's no guarantee we're going to get up to our targets. I think the technicals are starting to wane, but I suspect we've got a little bit more upside before this thing tops, and it's possible that it's going to hang in there and then top rather suddenly. So let's be vigilant, so to speak, on the market, and pay attention to the short-term clues. And right now those clues are pointing, I think, higher. There is the possibility that we've put in a short-term peak, so if we do break through today's lows, I would look for some downside. But if we hang in there, I'm looking for higher prices short-term before a larger correction. Okay, that said, have a great weekend if I don't talk to you, and I'll talk to you next week. Bye-bye.